VA loan versus USDA loan. Both are 100% financing loan products, but one of them could save you thousands or cost you thousands. I'm Jason Wood, and I'm here to break down exactly which one's going to be better for your rural home purchase. Here's what we're diving into today: who qualifies for each one and who doesn't, how the fees and costs actually compare, and what hidden rules could cost or save you thousands. Think of these loan programs as roads to the same destination. One is wide open with more flexibility, while the other one has guardrails with a little bit more restriction. You want to choose the one that gives you the smoothest path. VA loan eligibility. Active duty status requires you to have at least 90 plus days in active duty service after all your schooling, so while you're in your unit. If you are in the Guard or the Reserves, you have to have completed 6 years with no missing drill dates in order to be eligible for active duty, or be a surviving spouse of a veteran. With the VA loan, there are no income limits or geographical restrictions. Let's talk about the USDA loan eligibility. It's open to civilians, so there's no military requirement. Even a veteran can get a USDA loan. Household income must be below 115% of the median household income for that area, so there is an income limit. And the property must be in a USDA eligible zone. The USDA's definition of rural may surprise you because in a lot of suburban areas, their geographical map will still allow you to purchase in those areas. But it's important to use the USDA's website to see if the area you are looking in actually fits in the USDA's geographical footprint. The property requirements and flexibility, and here's where the two programs start to diverge a little bit. So here's what the VA loan allows: single-family homes, condos, and multifamily homes up to 4 units. Manufactured homes. You can purchase anywhere in the U.S. There's no geographical limitation. It must be your primary residence, and the home must meet the VA's minimum property requirements. Now let's compare that to the USDA loan. The USDA loan is for single-family homes only. It must be located in a rural designated area by the USDA, must be a modest home for the area, no luxury homes, primary residence only, just like the VA loan. No multi-units or income-generating properties are allowed, though. I worked with a veteran near Fort Carson, and he was able to use the VA loan to purchase a duplex where he lives in one unit and rents the other unit out to generate some income. This will not work with a USDA loan. Most people think that with a zero down loan, both loan programs are equal, but one of them doesn't allow you to buy multifamily properties where you might be able to produce a little bit of income. Cost and fee comparisons. Now let's talk about the real differences here. Both the VA loan and the USDA loan offer 100% financing, meaning there's no down payment required on either loan program. Upfront fees. Both of these loan programs have upfront fees. The VA loan has the VA funding fee. Depending on your usage of the VA loan, if it's your first time use, it's 2.15%. The USDA loan has a 1% guarantee fee. The VA loan does not have monthly mortgage insurance. The USDA loan has a 0.35% mortgage insurance premium, which is an annual premium paid monthly. The VA funding fee. The VA loan has an exemption for the funding fee for disabled veterans or veterans who've received a Purple Heart or surviving spouses. There's no exemption for the USDA's 1% guarantee fee. Everybody has to pay that fee. So let's look at the cost breakdown on a $300,000 loan. The VA loan with its 2.15% funding fee is going to have a funding fee in dollars of a little over $6,000, $6,450 in the VA funding fee. The USDA loan would have a $3,000 upfront fee, so upfront a little bit less, but it also has that monthly mortgage insurance, which is at 0.35%. That breaks down to $87.50 per month. So when we compare it over a 5-year period, we have $6,450 on the VA loan. On the USDA loan, because of the 1% fee with $3,000 and the monthly mortgage insurance, if we compared it over a 5-year period, the USDA loan costs $8,250. Now, if you're getting the VA loan and you had a funding fee waiver because of a disability, a Purple Heart, or you were a surviving spouse, now that $6,000 becomes zero. The VA loan becomes significantly cheaper, especially for those disabled veterans with a 10% rating or higher. So what are the qualification differences? Now, this is where the lender really checks under the hood. Credit scores. Now, the VA loan doesn't have a minimum credit score. A lot of lenders will establish a minimum credit score, usually around the 620 mark. We can go as low as a 500 credit score. Some lenders will only go down to 580. But like I said, most will hover around that 620 credit score as a minimum. The USDA loan is a bit stricter. It requires a 640 credit score. There's no options there. Debt to income ratio. The VA loan is very flexible when it comes to debt to income ratio. In fact, the VA loan handbook does not state a maximum debt to income ratio. They require a VA residual income calculation to make sure that you have enough money left over for your family size in the area of the country that you're purchasing in. We've done many VA loans upwards of 60+% in their debt to income ratio, which provides a lot of buying power. In comparison to the USDA loan is capped at a 41% debt-to-income ratio with 0 exceptions. The USDA loan is capped at a 41% debt-to-income ratio with 0 exceptions. Not even a decimal point. It has to be 41% or less. I helped a Navy veteran get a home in a rural area where his debt-to-income ratio was 45%. He couldn't qualify for the USDA loan, even though the home was in the USDA's geographical area, their geographical footprint where they could buy one. He couldn't qualify because of the debt-to-income ratio. So it was an easy decision to go with the VA route. He was able to get that house. Here are some real-world situations to help you determine which loan product is going to be better for you. Let's start with the VA loan. You're a veteran, especially with a disability rating, or you're buying a multifamily property. You want no mortgage insurance. You exceed perhaps the USDA's income limits, or the property you're looking at might be in a rural area, but it's not inside the USDA's designated rural zone. The USDA loan is better if you're not military related. It's a 0 down payment for anybody. If you meet the income limitations, so you're at or below 115% of the median income for the area, and you're buying a modest single-family home in a rural zoned area. And lastly, you don't qualify for any VA loan benefit. That's where the USDA loan can really help you out. The bottom line, if you're a veteran, the VA loan is usually the better loan because it has less restrictions, fewer costs, and a lot more flexibility than the USDA loan. Especially if you have a disability rating or you wanted to buy a multifamily dwelling, the VA loan is going to be the ticket for you. If you're not sure which one fits your scenario, I'm here to help. Click the link below to schedule a one-on-one appointment. You can visit me online at valoanguy.us. We want to make sure that your home loan purchase is as cost-effective as possible and you're getting the right loan program for your exact situation. If this video helped you out, please give it a like, subscribe, and share it with a friend. I'm Jason Wood, the VA Loan Guy, and I'll see you on the next one.